1. We're ready to go.
I guess we're co-hosts. Hi, Harlan.
Great to see you, John.
Great to see you too. So, everybody, I'd like to introduce you to Harlan Accola. He is in the reverse mortgage industry. He's with a company called Fairway Mortgage, and he's also the author of a book, Home Equity in Reverse Mortgages, the Cinderella of the Baby Boomer Retirement. And I have to say, it's a great read. I recommend it. It's a subject that, some of us have heard a little bit about, mostly, or at least in my lifetime, it's been a bit of a negative connotation. It got some bad press a number of years ago, but a lot of that's, changed. There's been some changes to the program and so forth. But in the conversation, I just want to say that I find that this makes so much sense, just like infinite banking makes so much sense to me. And I wanted to just have you, Harlan, talk a little bit about what was your journey like? When you first started, I think it was 18 years ago, or maybe, I don't know exactly how long you've been doing this, but this was not a positive thing to talk about to most people. They'd be like, oh, you're like a life insurance agent. Like, I don't want to talk to you. Reverse mortgages? Oh, that sounds bad. So what has your experience been in the journey along the road?
Well, I read a very valuable book a few years ago that I wished I would have. It should be required reading in high school. It's called Don't Believe Everything You Think. Well, I believed a lot of stuff that I thought, and it was wrong stuff. And so I used to tell people, and it's because I was shaped by people like Dave Ramsey and Susie Orman, who are nothing but financial entertainers. They're not financial advisors, or they don't have any licenses or anything else. They just make money by talking about a lot of stuff on TV. Not that it's correct, but it's on there. And so I was listening to them and reading their books, and I thought, well, okay, yeah, you should buy term and invest the difference. I learned that, way back when I was in my 20s. That's back in the days when that was a big movement of buy term and invest the difference, which of course changed the insurance industry for the better. And so I used to tell people, whatever you do not only buy term insurance and invest the difference, and pay off your house as quickly as you can. Get a 15-year mortgage. If you can, get a 10-year mortgage, and make double payments. Make payments bi-weekly, whatever. Just get rid out from under the mortgage. Because I went with my parents to a mortgage burning party in the 60s when I was 8 years old. So, right. Mortgages are evil. Right. Went through the Depression. They knew that you should get rid of mortgages. Right. And so that's where I was coming from. And so I told all of my clients, my mortgage clients, make sure you don't buy life insurance that is that whole life stuff and expensive stuff. Just buy term and invest the difference. And, oh, by the way, pay off your mortgage as quickly as you can. I'll get you into a mortgage and increase your payments, and you can pay it off quicker. Right. And pay less interest. Right. And so when I was invited to a reverse mortgage, and when they brought up the reverse mortgage, I said, stay away from those things. They're evil. They rip off the old people and screw the kids. Just stay away from them. So I was invited. Two things happened within a 2-month period of time. First, a life insurance agent came to me, and he said something that I have never forgotten. In fact, it's still on the back of my business card. I changed it a little bit. On the back of my business card, it says, if what you thought you knew about money and mortgages was wrong, when would you want to know? He said, if what you thought you knew about insurance, life insurance, was wrong, when would you want to know? And I said, well, I don't think I'm wrong, but I guess right now. And he kind of explained that to me, and I had an epiphany of what was going on with insurance, and bought my first policy. And then at that same time, I got invited to a reverse mortgage conference in Miami in January. Now, if you live in Wisconsin, where I was at the time, you go to any conference in Miami in January.
Of course you do.
Because it's 20 below zero.
I've been to Wisconsin.
There you go. Good reason
Yeah.
not to come here in December or January. So what it comes down to is I went there fully expecting to just get out of there as quickly as I could and go sit on the beach. And what I learned there changed my life and changed the life of over 1,000 clients that I personally worked with and thousands more since I've been at Fairway. And I realized I was wrong. And, if we had a seminar entitled Reverse Mortgages, Cash Value Life Insurance, and Annuities, the antidote to a better retirement, nobody'd show up. Even yet, those three things are three of the most important things to have the most efficient, safest retirement that you can have. And yet nobody wants to hear about them because they're expensive, they're bad, they're whatever. And so what I've learned over the years is that emotionally, people are very angry about reverse mortgages. People don't just agree or disagree. They just get mad sometimes when you even bring it up. 95% of people, including professionals, think that reverse mortgages are bad or evil or something to stay away from. At the very best, a loan of last resort. If you're broke and you're eating cat food, maybe it is justified. But otherwise, stay away from it. And so to be able to combat that, you need to deal with the emotions, which I do in my book when we talk about things like drug, sex, and reverse mortgages and horseless carriages and so on that seem to have nothing to do with reverse mortgages. But people think weird. I think weird. And you start believing things that you think, and that's dangerous until you have the facts. And so many of us I read an article once or a chapter in a book that the bigger the decision, the more emotion comes into play. And you'll see that even amongst financial advisors and stock traders. And they'll say, how could anybody have missed this? How did people miss the 2008 crash? These were a lot of smart people.
Yeah.
And so the bigger the decision, the more emotion comes into play. The bigger the decision, the more logic that should be used. And yet it's the other way around.
Yeah.
So when I finally started looking at the facts and realizing that my net worth would be better, my tax situation would be better, and my cash flow would be better and safer if I did a reverse mortgage the day I turned 62, and I encourage other clients to do the same, that's when the light bulbs really went off. And I understood that if I want to go into retirement with number one, more cash flow, number two, pay less in income taxes, and number three, and most importantly, a higher net worth and thus a larger legacy to leave to my four sons, it all become very clear that, that I need to use all of these tools. Who wouldn't want those three things in retirement? Everybody would want those.
Sure.
But it's going to be necessary. Everybody wants to go to heaven, but nobody wants to die. Well, everybody wants a good retirement, but everybody wants to do it with 401ks and a paid off house. It doesn't work that way. You need more than 401ks, you need more than IRAs, and you don't want a paid off house. And that's what is, it's the so much against conventional wisdom that it is hard for people to get used to, but a very short view of the facts makes it pretty clear.
Yeah. Well, the word that's in my business name is cash flow. And, I love the fact that reverse mortgages and the cash flow that can come out of them, or the lump sums, or whatever way you take it, it's not similar to reaching into the cash value or leveraging the cash value in a whole life policy. So that, again, I mentioned to you earlier that I'm a big fan of a book series called Confessions of a CPA. And his whole, deal is to, pay your taxes now, don't pay any taxes ever again on that money, try to go tax-free, tax exempt on the way down the mountain, Mount Everest, climb up, accumulation, distribution on the way down. And this, to me, they marry together: infinite banking, whole life insurance policies structured, specifically for cash value. In this idea of slipstream, you and I were talking earlier, and there's so much I want to make sure we cover, which is, yes, you mentioned 62. I've got people probably going to listen to this maybe you will too, but 62, well, I'm 45, I'm whatever age. What does reverse mortgages have? I'm going to shut this off right now. I'm not even going to listen. But no, this is for them too, because this is part of the planning process. This is the future income streams, right? That they can tap into and do it tax-free, and you're not getting that with your other retirement planning options, right? So
Well,
can you
so
speak? Yeah, go ahead.
It's I read a very valuable book when it first came out, The 7 Habits of Highly Effective People by Stephen
Steve
Covey.
Covey.
Most people have heard of that. I can't quote all the 7 habits, but I can quote one that I've lived my life by most of the time, and that is begin with the end in mind.
Mm.
If this is where you want to be when you're 80 or 90, if this is where you want to be when you're 50, these are decisions that you have to make today so that you'll get there. And so many people make decisions without considering, well, what's my end game? And so I often ask people, especially people that are younger, have you ever been to a funeral? In fact, I had 5 financial advisors on a call this morning, and they were all under 50, under 40 probably, relatively young guys. And I said, have you guys ever been to a funeral and saw engraved on a casket or a cremation urn or on a tombstone, I died with $422,000 in home equity, or whatever the amount was? No, nobody has ever seen that. Well, why does everybody live their life like the goal is to die with a paid off house? If that's the case, that's not the big goal, then why is everybody trying to do it? It's really odd. And so when you're in your 30s and 40s, my second son just bought his first house at 30 years old, got married last year and bought a house this spring for him and his wife. And he said, well, Dad, I'm getting started on building some equity so that I can do a reverse mortgage when I'm your age. That's the proper thought process.
Right. You've done your job there, Harlan.
Yes, I was thrilled that he got that. And so, because of course I was stupid back when he was 18. But,
yes.
It's amazing how much your father learns as you get older. So the issue is that he knows that he bought that house not only to live in, but as an investment so he can use that equity for his retirement when he gets into his 60s, even though that's 30 years away. So when people are in their 40s and their 50s, why are they trying so hard to pay off the house and acquire more equity, which is worthless? And, I often bring this up. I'm glad you got this on video, because this is cash and everybody's familiar with cash and what you can do with it. And I can go get maybe a tank of gas for my my SUV or a couple of groceries. But this is equity. It looks like cash, but it's really just a squeezy little $100 bill, little ad specialty. This is worthless. It represents something, but it's worthless. 100%. And people will get offended when I tell them this, John. 100% of your equity in your house is worthless, because they'll come up to me and poke me and say, yep, don't need you guys anymore. Got my house paid off. It's free and clear. I always say the same thing. I'm sorry to hear that. Excuse me. Right. Not because I'm being rude or obnoxious, but I'm sorry to hear that you've got 300,000, 400,000, 500,000, $1 million all tied up in a worthless asset that you can do nothing with until you sell it or mortgage it and turn it into these, because this is the only thing of value in retirement.
Well, plus there's no return on that equity. I mean, you get equity through appreciation, but the equity that you're putting in cash and trying to pay it off, that's got no rate of return, right? In fact, you're losing money because it's not working for you.
Absolutely. That concept is so missed by really smart people. I was just talking to a professor in California, owned a $2 million house that was paid off. And he told me, you don't understand. You're in the Midwest. Out here, our houses go up by 8% a year. I mean, I can feel the money going up in this house as I'm sitting here. And I said, with all due respect, sir, it's worthless to you, and your house is going to go up in value whether or not you have a mortgage or not. And it took a couple of hours, 2 different conversations to get that point across to him. He's a smart guy, but he doesn't understand that he's getting a 0% rate of return on what's in there. Now, people can argue and say, well, yeah, but I eliminated a mortgage, so I'm saving 3%. Well, that's fine. But then the argument is, did you want to put your money into a illiquid asset that gives you a 3% rate of return? That's not very smart.
No.
And yet all kinds of people do that. I asked a financial planner once who really didn't understand life insurance or reverse mortgages. And I said, what kind of person, if I came to you and I said, hey, Frank, I've got $500,000 and I'm going to put it into an illiquid asset that I don't have any control over, and somebody else has control over unlocking it, and regulations, all that sort of thing, and it's only getting a 3% rate of return. He said, well, I tell you not to invest in it. I said, why do you have a $700,000 house paid off then? So, because that's what it is. It's an illiquid asset with less than a 3% rate of return. So nobody would really do that, but yet thousands of people do. 54% of people, 56% of people, the day they turn 62, have their house paid off. And many of them have less than $130,000 in assets, that of liquid assets.
Yeah.
So it's crazy. And then 44% of people are still making a mortgage payment the day they turn 62, the other side, and they're still making a mortgage payment, and they're pulling money out of 6-8% assets, something they're getting a return on more than 5%, and putting it into an illiquid 3% asset.
I know. I mean,
no, that doesn't make sense. Why do we do these things?
Yeah. Well, you know, when I first got into the insurance business, I mean, I haven't been in it that long, and I started out with mortgage protection. And so what I started to realize when I was buying these leads, that I had a fair amount of leads that were 70-year-old plus people, and they had just taken out a mortgage of $200,000. And I said, they're probably not putting an addition on the house. They're probably using it as income. So they're going to use it as income, but now they're on the hook for this debt, right? They're required to make a monthly payment, right? So now they needed income, and now they have a payment. I said, this seems crazy, totally crazy. Well,
and that happens over and over again, John, is where people in their 60s, 70s, even 80s and 90s. Now, I would argue that if you're 95 and you're not in great health, take 100% of your house out and go take an around the world cruise. Go have a great time, because you're never going to pay it back.
Right.
But if you're in your 60s and 70s and you're in reasonable health, why on earth would you take out a mortgage that requires you to make monthly payments in an uncertain environment with uncertain health for the next 30 years? I mean, that is foolish by any stretch of the imagination. And I always tell people, they say, well, I don't really like mortgages. I don't like risk. Well, so I'll just go with a regular mortgage because that's less risky.
Whoa.
If you want risk, go sign up for a $1,500 payment for the next 360 months. That's risk.
Yeah. And the fact is, everything that could happen at any age can happen probably at a greater percentage when you're in your 60s, 70s, whatever. You're going to get disabled. You're going to lose your job, right? You're going to, and hey, you don't have the cash flow. Now you can lose your asset, I mean,
exactly. Yes, so it's sad because, and this especially happens, John, this is a huge caution that I don't want to forget. Husband and wife, and they're doing great with his pension and her Social Security and his Social Security, and they go out and get a mortgage, and then he dies a year or two later. And now she gets a huge decrease in income. I've seen it over and over, and goes into foreclosure and loses the family home because they put a forward mortgage on, and they didn't even know about a reverse mortgage because their lender didn't tell them about it. Their financial planner didn't tell them about it because, well, that's a loan of last resort and we don't think that's a good idea and they're expensive. And now the poor people have a mortgage payment, and the poor widow, 20%, 1 out of 5 widows are in poverty in the United States, and most of them have never been there before. That's awful. In one of the richest countries in the world, we're going to have, and you know that life insurance and reverse mortgages could fix 95% of those cases, that a wife would never be in trouble when her husband would die because the life insurance would cover her living expenses and the reverse mortgage would give her a place to live.
Yeah.
And it's crazy that they don't even think about that. I was with a couple in Colorado Springs, and they had $5,000 a month in income, and they still had a $1,200 payment. And he said, "We don't have any problem. We're still saving money. I mean, we don't need a reverse mortgage." And I said, "Can we just take a look at what your income, you've been in for a heart condition before, but whether or not you have been, everybody has a potential to drop over a heart attack in their 70s or whatever else." One
Oh,
of my best friends is laying in the hospital right now, headed to hospice, 62 years old,
I
leaving,
just
going
had
to
a
leave a
friend
wife.
at 56 drop dead the same day. He just had
Yeah,
a
we're not
cardiac
guaranteed. So
event.
I said to this Colorado Springs guy, I said, "What happens if you pass away? How much income will your wife get?" He said, "Well, she'll get quite a bit yet." Well, we figured out he's got a life only pension, and all she'd do is end up with his Social Security, which was $1,600 a month, and her payment is $1,200.
Yeah,
They only have $200,000 in savings.
it's the cat food. Yeah, you'll be eating cat food and
So
you'll be
it's
homeless
really,
and you'll be
exactly.
homeless.
That's right. It's really sad that people don't think a little bit ahead, further ahead from that. But I have to. That's why I admitted right in the beginning, I felt this way too. I can understand why people don't like reverse mortgages. They've heard of bad things about them, and let's just face head on why people don't like reverse mortgages. There's two major reasons. Number one is foreclosure. They've heard of somebody that lost a house with a reverse mortgage. Dave Ramsey talks about it on his radio show. How can you lose a house when there's no payment? Well,
Mhm.
if you don't pay your real estate taxes, you will lose your home,
Sure.
but you'll lose your home with or without a reverse mortgage.
Right. It
Uh,
has nothing to do with reverse mortgage. Yeah.
exactly.
Yeah.
And so, but people hear about that. I've had people say, "Well, I tell you what, that reverse mortgage didn't work out for my uncle. He lost his house. They foreclosed on him." I said, "Really? Why did that happen?" "Oh, I don't know. I guess he didn't pay his taxes or something." Well,
I don't know.
that might have something to do with it.
That'll do
So
it. Yeah.
that's something that we try very hard to qualify people in the beginning, so that we know they've got enough other assets, they've got enough income that they're going to be able to afford to pay their taxes for the foreseeable future to the end of their life.
You
So
know what's can I just interrupt there for a second? What's so interesting about that is there's all this training, knowledge, assessing that somebody's going to be able to continue to make their homeowners insurance, your tax payments, real estate tax payment on a reverse mortgage. There's no such thing for a forward mortgage.
yes.
So this is safer all the way around. I mean, they're educating you. They're not going to just give you this reverse mortgage. They're going to let you know you got to make these payments, right? Do you have the wherewithal to do it? Do you, have that capability?
Go so far, John, if it doesn't look like you have a history of making your payments on time, we'll put aside a huge part of your line of credit, if there's room for it, to make the payments for you, so that you will be guaranteed not to forget.
Yeah,
Uh,
like, why isn't this done for a forward mortgage? I mean, like,
Yes, that's
crazy.
the thing. When people say it's risky, it's compared to what? Well, it's risky to be alive. I mean, it's risky to get in a car.
Yeah, right,
It's
right.
risky to go out and catch COVID. There's a lot of risk in life. But the second reason why people don't like reverse mortgages is because there's more than one kid who has complained that he didn't get his inheritance. And there has to be a fundamental shift on, just a second, whose money is that? If somebody dies with no money left in their IRA, that's considered okay because they spent that money. If somebody dies with no equity left in their house or very little equity left in their house, that's somehow horrible. What's the difference? This is equity, this is cash. They both have value when they're converted to cash.
The cash.
I would much rather end up with a life insurance policy, and my kids are going to get a life insurance check within a month after I die as beneficiaries of my life insurance policy.
Right.
If there's money left in my house, they're going to get that too. But if there's nothing left, I want to spend every dime of equity that I can. That's the first thing I'm going to spend. And if there's no equity left, that's okay, because I intend to leave a legacy in a different way to my children. But what if I didn't do real well and I go to 95 and I've spent everything? I've spent all the money in my equity. I spent all the money in my savings account and I leave them nothing. Is that okay? That depends on what I want to accomplish. But the most
Right.
important thing is what I leave behind. I intend to leave them a legacy with permanent life insurance, and I want to do that. That's not everybody's goal, but it happens to be my goal. And I know it's going to be more valuable to leave them a life insurance policy than it is to leave them my house, because we have no idea what the house is going to be worth. We don't know how much equity is going to be left in it. We don't know the value next year, say nothing about 20 or 30 years from now. But I know if I have a permanent life insurance policy that's paid up, I know my kids are going to get a check for 250,000 or whatever the death benefit is. So that's a guarantee. And there's never, your industry has never not paid out a death benefit in like 300 years. So, I mean, that's pretty close to
That's a
something that for
is
sure.
yeah, that's a guarantee. That's a true guarantee. Well, I always say there's a day of reckoning. For a whole life insurance company, there's a day of reckoning. They can't get out of it. You're going to die or you're going to live too long, and they're going to pay you regardless. Whether you live today, you're going to live to 121, but they're going to cut you a check for whatever that death benefit is if you live too long. If you don't live too long, then they're going to pay your heirs. They're going to have to pay. So it makes me think about the fact that, yes, how people have wanted to get rid of their mortgage. They want to pay that down. They want to do this velocity banking. They want to do right and to get rid of it, which is, hey, people should do what they want to do. But what we're trying to do is educate them that there's an option. So if you have some extra cash flow, I believe that I think you should put your money through a policy first, then you do everything else you want, right? And so if you've got some extra money and not take a 15-year, take a 30-year. If they gave you a 40-year mortgage, take a 40-year mortgage, right? And then just take that extra money, put it into this guarantee of a policy, right? And you are paying down your mortgage regardless, whether you're trying to accelerate it or not. You're going to pay it down. And if you live long enough, you're going to build up equity. But as you say, which I love in your book, is the 3 buckets, right? And that's one of the buckets of money. And it shouldn't be locked up, because it's like you said with the rubber dollar or $100 bill, it's not valuable if it's just locked up there. I mean, and I've lived this life. I had a lot of equity in my house, but I wasn't in a situation. I switched careers. It was before I got into this, and I didn't have the income, so I couldn't tap any of the money. It's like it's all my money, but I couldn't tap it, and I wasn't 62. So unfortunately at that point, but then again, it was fortunate. It gave me 10 more years to get to 62. So that's how I look at it, is like, take this extra money and, just be more effective, with the flow of cash in your life, put it through a policy first. Yes, buy an asset that you're going to live in. But I want to get to the point of what most people probably think of, what I thought of a reverse mortgage, was somehow I was going to lose the house. And what if, or I was handing it over to a mortgage company upon my death. What if my kids wanted to own it, right? That I had just taken that off the table. But that's not the case, right? The case is, if there's a husband and wife, one passes away, the other gets to stay, right? Nobody's getting kicked out, right? And even when the second spouse passes away, it doesn't mean that there isn't an opportunity for children that are left behind that might want to keep the house, right? There's ways. So if we could talk a little bit about that.
Yeah, it's interesting because I talked to these young folks this morning, younger meaning under my age, I guess, under 40. And I asked them, who owns your house right now? Do all of you have mortgages? And they all raised their hand. I said, who owns your house? And they said, well, the bank does. I said, that is all kinds of people say that. Boy, you've got a nice house here. Yeah, me and the bank, we own this. But the bank never has any ownership. They don't want ownership. I've worked for banks, mortgage banks, for 18 years now. It's a failure if we end up owning a house of our clients. It's called foreclosure. Then something went wrong. So we don't want any houses. We're not interested in owning houses. We're
Yeah,
not
you're not in the
landlords.
real estate business.
That's correct. We're in the lending business, and we lend money and we collect interest. It's that simple. So we're not in buying houses and trying to sell them. That's for real estate people or developers or whatever, but that's not
Investors.
us.
Mhm.
So we don't have any ownership of the house in a forward mortgage. We have a lien on the property. So there is the mortgage that is filed, which represents the lien, deed of trust, as it's sometimes referred to, and that's where the confusion comes in. But the deed of ownership belongs to the owner.
Hmm.
And so there's two different pieces of paper. The one deed says, who owns this property? Well, that's owned by Harlan Accola and Brenda, his wife. Okay, so Harlan and Brenda own that property. Well, let's look further in the court records. Oh, they took out a mortgage for $250,000. So we have to talk to this bank. If they sell this house, the title company takes a look at what is Harlan and Brenda's obligation when they sell the house. Oh, there's that mortgage and there's still $100,000 left. So in a forward mortgage, I own the house and the bank has a lien subject to the terms of the loan that they gave me a year ago or 20 years ago or whatever.
Right.
It's no different with a reverse mortgage. We file a mortgage over the top of the property, and the person still has a deed of the ownership of the property. Now, the difference is we don't make them pay until a year after they're dead. They can pay anytime they want, but it's very unusual terms. And by the way, tell all of your clients, John, if you can borrow money and not pay until a year after you're dead, you should really look into that.
Yeah, that sounds like a good deal.
That's really good terms. Try
I
that
like
at a rate
that deal. Yeah, exactly.
And so, or whenever you want to leave, of course. So the issue is this: I still own my property when I enter into a reverse mortgage, subject to a mortgage that needs to be paid a year after I'm dead or whenever I leave the house. If I die, my wife can still stay in the house. If my wife dies, then my kids have a year to decide what to do with the house. Now, there's only, and this is very important for people to understand, what happens now? They say, oh, that's all well and good. What happens when you die? Then there's a problem. Well, no, if you understand what's going on, there's only two things that can happen. My house is worth more than the mortgage, which happens most of the time, or my house is worth less than the mortgage because I died in a year like 2009 when the market crashed. Okay, so let's use the first example. My house, let's say, is going to be worth $600,000 when I die, and I owe $200,000 when I pass away. Okay, well then the kids will end up selling it, paying back $200,000, which includes all the interest that's been accrued over the period of the years, and they go off with the other $400,000. But let's say that I took out more money, and now I owe $500,000 at the end because I lived to be 105, and now the home values have went down because there's a crash, just like in 2008, 2009. And so my house is only worth 400,000 and I owe 500,000. And they say, see,
Right.
now there's the problem. You're upside down.
Yeah, it looks like you're upside down, like as they,
Yes.
right?
But
Underwater.
I'm not underwater or upside down because FHA has agreed that this loan can be paid off with the value of the house plus the FHA, Federal Housing Administration insurance that guarantees that I will never have to pay more than the house is worth.
Yeah.
So my kids, FHA mortgage insurance doesn't only protect me, it protects my kids and my estate and my trust. And so I never owe more than the house is worth. So I'm $100,000 upside down, like my uncle was when he died at 94 years old. That amount was forgiven. We sold it on a short sale, got a tax deduction for his estate, and the other $300,000 that was left in his estate went to the kids, went to his heirs. But the difference of the upside down part was paid for by FHA. So the kids didn't get any equity, but they didn't have to pay anything. And they got the other $300,000.
Well, it's
So
to me, yeah, go ahead, sorry.
So the bottom line is if it's good, the money goes to the kids.
Right.
If it's bad, the bill goes to FHA. It's like going into a casino, and in front of the casino, it says, you are not guaranteed to win, but you're guaranteed not to lose. I'd go
Right.
to that casino. I'm not a gambler, but I'm going to go
Right.
to
Right.
that.
Me neither. Yeah, exactly.
I'm guaranteed not to lose.
No, I
Uh,
love it. I love it. One of the things that we were talking about earlier is these, folks that take a forward mortgage. Now they're committed to a payment every month. And if you did a reverse mortgage, you're 62 and you either take a stream of income every month. Not only did you not have a payment anymore, you're actually receiving money. So you have some cash flow. It's like a double whammy, I mean, of goodness, right? Is I don't have a
well,
payment, but I'm actually getting some cash flow, right?
and
Or I
that's
could take
where
it as a lump sum, whichever way I want to do, right?
you're exactly right. And that's where I should bring in what you like from the book, the chapter in the book
Oh,
about the three.
nice. Look at
So
you. You're so prepared.
hey, I'm talking to John. I better be prepared. Uh, so, so here's the deal. This is so simple that even I can understand it. And the reason I wrote this up is because my 16-year-old son complained about that a reverse mortgage is not good for the kids. He said, Dad, what you're doing might be fine for you, but it's not good for us kids. And this was when my son was 16 years old. He's 26 now. This was 10 years ago. And I just grabbed a legal pad on the kitchen table and I drew these 3 circles and 2 rectangles. And I said, no, Isaac, it's not like that. Here's the deal. Everybody that owns a house has 3 buckets of wealth. Bucket 1 is your ability to make money. That's my W-2 wages and my, what you make for being an employee, or commissions if you're a independent contractor, whatever. And then bucket 2 is, of course, what you guys manage in the financial planning world. That's 401ks and stocks, bonds, life insurance, savings accounts, whatever, mattress money, whatever you're putting away for the future.
Yeah.
And then bucket 3 is our bucket, home equity. So let's think about this. I said to Isaac, there's 2 rectangles. I'm going to show you 2 wallets. Our wallet right now today on the top, that's our pre-retirement income. And the wallet that's on the bottom, our post-retirement wallet. So let's just talk about where we're at right now today when I was in my 50s. So we've got all of this money that's coming in from my income from working hard, and it's going into the top wallet. Now, most of it evaporates right off the top. We have to buy food and clothes. And my goodness, we got a lot of groceries because you're here, and we got to buy your basketball shoes, and we got to send you to school and so on and so forth. And so most of that evaporates right off the top. But we try to save, and I took out the $100 bill to get his attention, which held his attention. You can imagine the attention span of a 16-year-old. So we're going to take some of that money and we're going to drop it right into our investments for the future, and the life insurance and all of the money that we're putting away for the future. But what you don't realize, Isaac, is our house payment is $2,000 a month. That's 20 $100 bills that goes into bucket 3 every single month. Every month we give away 20 of these $100 bills that goes into bucket 3, into this house. And he said, wow, that's really a lot of money. And I said, well, we could live in a tent. We don't have to live in this nice house. But he agreed that it's a good idea to stay in the house. So I said, we're going to put a lot of money, hundreds of thousands of dollars is going to go into bucket 3, and it's going to turn into equity. We're also going to give as much money as we can to our financial advisor and put it into our insurance contracts. And he said, well, that's good because that kind of helps out with inheritance and all that sort of thing. He understood that that was a good idea for being an heir.
Mm-hmm.
And I said, so now let's say that we get past 62 and we decide to slow down, Isaac, and we're not working as hard. There's not as much money coming in from bucket 1. Where should we get our money? Should we hope that you graduated with a good job and you'll be able to send us money, or we can come and live with you? Or should we try to take care of ourselves? And he said, I think you should take care of yourselves. And I said, okay, so where are we going to get our money? And he said, well, you'll get it from the money that you give to your financial advisor. That guy comes in here every couple of months and you talk to him. So he'll give you money back. His name's Jason. Jason will give you money. And I said, okay, that's a good idea. But what's wrong with going and getting some money from the mortgage company that we've been sending all of this cash to, hundreds of thousands of dollars between now and when I turn 62?
Yeah.
I said, that's what you call a reverse mortgage, Isaac. So instead of sending the money to bucket 3, we're going to pull money out of bucket 3. As you just said, either we're going to stop a mortgage payment, or we're going to set up a line of credit, or we're going to take a monthly checkout and reverse the whole process. Hence the name, of course, reverse mortgage.
Right.
And he said, Well, yeah, but why don't you just pay off your mortgage and leave it sit there? I said, we could do that. That would be
Yep.
possible. But if we do that, I'm going to tell you something very important, Isaac, that I never want you to forget. The more cash that we put into bucket 3, the less money we have to put into bucket 2. And he said, well, that's pretty basic. I said, is it or not?
Yeah.
Think about that. The vast majority of people think it's okay to flood money to bucket 3 and pay extra payments so that you can pay your house off and go to cocktail parties or weddings and brag and say, I've got my house paid off.
Yeah.
But
Then I
what
gotta
does
pay
it
the
accomplish?
bills.
It doesn't. I can't pull money out of there.
Yeah.
So I said, Isaac, what we're going to do when we get to 62 is, yes, your worst fears are realized. We're going to do a reverse mortgage right the day we turn 62, which now is only a year away from me. And I'm going to pull that money out of bucket 3 first and stop making payments to bucket 3. And that will make bucket 2 last longer. And so as a result, we'll have more money to live on while we're in retirement. But more importantly, for your interest, there will be a bigger inheritance. So what do you think about that, Isaac? He said, I think you should get a reverse mortgage. So he was turned
Hurry
around
up and turn 62. Yeah.
Exactly. So he was turned around with this diagram inside of 5 minutes because he realized that not only was it a better deal for mom and dad, it was a better deal for the heirs. No, most heirs think it's a bad deal because there's not as much money left in bucket 3. If I have less equity and if I give up equity in bucket 3, but I gain cash in bucket 2 because it's more efficient and I've got more money in my life insurance policy and I have more money in my annuities, I don't care if there's less money in bucket 3. Is
Right.
anybody going to complain if I have less money in my right pocket as long as I've got more money in my left pocket?
Yeah.
It's the
Exactly.
same
Yeah.
pair of jeans. I've got money in each one. So that's the quick story on the 3 buckets that you liked from the book, which I've used literally hundreds of times because, of course, people think that you're losing something when you do a reverse mortgage. You are trading equity for cash. You're not losing it.
Yeah.
It's trading.
I hear, we both have heard people over the years talk about, well, my house is my retirement, right? And I said, geez, how's that going to work? But I don't typically get into the conversation. I just kind of, okay, yeah, and kind of chuckle a little bit. But I'm like, what are you planning on doing that you think it's going to be worth? Hopefully the market's good and it's going to be worth a lot. And maybe even today, like, oh, I still owe 100,000 or I owe nothing and I can sell it for 500,000. Now I got 500,000 I can live. Well, where are you going to live? Like, you're going to have to go find something else. Oh, well, I'm going to downsize, So today downsizing means you got to spend 300,000. So now you've only got 200,000. And I go, you needed a place to live. Did you really want to? Now, sometimes people want to leave because it's too big, right? We had this huge house, so we understand that is going to happen. But the fact is if you're happy there, you can actually use it as part of your retirement. But that's not how I think most people think when they say that's my retirement. They're thinking, hey, I live in Boston and the market's really, I'm going to move to North Carolina where I can get a less expensive house, right? I got to move away. And hey, warmer weather, it's nicer. But that's what they're thinking. They're thinking, this house, I'm putting all my money. I cashed out my 401k because I lost a job. And I'm going to put an addition on the house and I'm going to spruce it up and do all this stuff. But in the end, I think they think about selling it and taking a lump sum, but they don't have to do that with a reverse mortgage.
Well, you mentioned something before, John, that is really what we've used a lot, and that is Mount Everest. You climb up Mount Everest, and then you go down in the decumulation phase in retirement.
Yep.
What a lot of people don't realize, there's more people that have died on the way down Mount Everest.
Exactly.
So it's more dangerous and there's more pitfalls going down than there is going up in retirement. And so there's so many risks that can happen from health and from the market going down and so on. And so think about investments for a minute. They take a look at their stock portfolio and they say, wow, it used to be 100,000 and now it's 1 million. That's pretty cool. It's really went up. Okay, well, if they went to retirement and they asked for some money out of that stock portfolio, and the financial planner said, oh, no, you can't take any money out of here. It's nice that it went from 100,000 to 1 million, but you can't use that. That's for your kids. I mean, you can go brag about it, but you can't use it.
Yeah.
I mean, they get
That's
mad
insane.
at that financial planner. They say, what do you mean? That's my money. I want some of it.
Yeah, that's why I did this.
They give us $1 million and they don't ask for it back.
Nope, never ask for it back. Yeah.
They give you $1 million, they want it back.
Exactly.
So why don't they ask us in bucket 3 for their money back? Because it's cultural and it's an investment that they're going to pass on to their kids. And, you know, even when somebody downsizes, we just had somebody that moved to Asheville, North Carolina, because they wanted the 4 seasons and they still wanted a little bit of snow and they wanted to be in the mountains. And they moved from Minneapolis down there. Well, they went from a $700,000 house in the Minneapolis suburbs to Asheville, and they thought they were going to get a lot cheaper house. Well, he wanted a house with mountain views with a little stream going by. Well, that's not 200 grand in Asheville, North Carolina. There's a reason why the Vanderbilts went there. And so the issue is that he ended up having to buy a $600,000 house. But with the reverse mortgage, he only had to put $300,000 down, and he never has to make a payment for the rest of his life. So even when you downsize, you should still use a reverse mortgage. He could have paid cash for the house because he sold the house for $700,000. He could have bought a house for $600,000, but instead he realized his realtor told him, "Hey, you can buy a house for 300 grand, and it's a $600,000 house. Fairway will come in with the other 300 grand, and you're done making payments until a year after you're dead." And he said, "Where do I sign?"
Wow,
I said,
this
is too good to be true. This isn't right. And what's the catch? And she said, well, the catch is at the end, your kids will get less money because that 300,000 is going to gain interest. And so the kids are going to get less money. He said, my kids are doing better than me. I don't care. He said, they're going to want to come and visit me and see my $1 million mountain views.
Yeah, exactly.
I just got his testimonial video for 5 minutes that was filmed telling about that, which I'd be happy to send to any of your listeners.
Please do. Yeah.
It's an awesome story that now he's got $1 million mountain views and he got a house for half price and he never has to make a payment and he's still pinching himself and he didn't believe it until he got to the closing table.
Right.
And
they,
no payments.
They gave him the keys to the house.
Yes, exactly. Something was going to happen that somebody's going to
right. Yeah, we're going to pull that right out from under you.
Exactly. So whether you're upsizing or downsizing, exactly. So whether you're upsizing or downsizing and selling a house, you should do a reverse mortgage one way or another. So if you're going to stay in your house in Boston and you want to have some more income, let's pull some money out and use it. If you're going to sell your house in Boston and move to the Carolinas, okay, well then let's get it. When you get a cheaper house, still pay half price. And if you're going to upsize and get a more expensive home because you're moving from a cheaper area like me to a more expensive area by my kids, well, then I got to pay more for a house. But I don't have to pay as much because I pay half price when I'm 62. So that's a situation of when we properly use the options that we're given, it changes everything. And we realize, oh, okay. Well, that's a little bit better than I thought. In fact, it's a lot better than I thought. During the conversation, then when we talk to somebody about a reverse mortgage, John, it invariably goes from, I've heard these are really bad. Within 45 minutes, well, this sounds too good to be true. Are you sure? Either one is correct. It
sounds like my infinite banking policies. Yeah. It sounds too good to be true. Why isn't everybody doing this? Exactly. Like, well, all 62-year-olds should be doing this, right? And do it right away. And the other thing I want to make sure we touch upon is that if I grab this equity through a reverse mortgage as a lump sum stream of income or what have you, when the market does appreciate, continue to appreciate, if it does, then I've locked myself out of that cash that became available through the appreciation, but that's not true either, right? I mean, it could actually appreciate and you could go back again and get some more, correct?
Well, I wish I had $1 for every time somebody said the bank takes the house. And I also wish I had $1 for every time somebody said, well, I'm really best off waiting until I'm older and the house goes up in value. And neither of those are true, because it is true that you get a higher percentage when you get older. And it is true that if your house goes up in value, you would get more money. But there's something called refinancing. People don't think you can refinance a reverse mortgage, but you can refinance a forward mortgage. If I take out a 30-year mortgage, does that mean I have to be in the house for the next 30 years and I have to make those? I don't know of anybody that's made 360 equal payments, but I know people that have 10 30-year mortgages and they're not 300 years old. They kept refinancing as the rates went down. You can also refinance a reverse mortgage. We did a number of them last year because everybody recognized that not only did interest rates go down, which affects the amount of money you can get, but also that their home values went up. So we had people redoing their reverse mortgage, pulling out an extra 30, 40, 50, 100, $200,000 and resetting the number. And they were able to enjoy it from the time they were 62 until they were 72. And now they're doing it again and enjoying more. But if it would have went the other way, like it did in 2008, and the values went down, you don't lose the money you already got. So if things get worse, you just sit tight and don't do anything and just keep enjoying the money that you were given.
Sure.
But like my uncle who went upside down in 2009, it didn't matter. He still got his money and he was able to use it. They didn't ask him for his money back. It's non-recourse. And so when he died, he was upside down. He got more out of his house than what it was worth. But if it would have went the other way and the house would have been worth more, we would have refinanced him and got some more money out. So you're covered whether the market's going up or down, whether you're young or old. You don't want to wait. We've done the numbers over and over, and you are not going to gain by waiting. That's why I'm doing mine, my 62nd birthday.
Yeah, and as you say, you don't want to wait because today it's just paper money. It's printed on a screen. It's printed on a piece of paper. It's equity that's not accessible. If you don't take it off the table, right? You just won it at the craps table. If you don't take your money, you didn't really win anything, right? But you don't really have any equity if you don't go grab it. So that's why you say when you're 62 and you've got that kind of equity, you should at least consider a reverse mortgage. Take all that equity now, because if the market does turn similar to what we had in 2007, 2008, then you're gonna, that if you didn't grab it, it's gone. It was just paper money. I mean, when I say on paper, it wasn't real. It wasn't physical. It wasn't physical cash. It was just, hey, we're saying that's what it's worth today. But if it was 600 and it goes down to 400, and you can't grab that 200 or a portion of that extra 200,000. It's gone, right? It was just paper profits, so to speak, right? But it's not really profit unless you take it.
Exactly. That's so true, because no matter how much you brag about how much equity you have in your house, you can't rip off the screen door and go get some groceries with it. No. It's or the front steps don't buy you any tanks of gas, and people forget that.
Yeah,
that it's just not available.
Yeah, I want to go back to, if you don't mind, a story you told me earlier, which is your own experience with meeting Nelson Nash, learning about the infinite banking concept, and sort of your conventional thinking, which is the standard conventional thinking, was I get caught up on rates, right? I was wondering if you could share that story with the audience.
Yeah, that was some very valuable wisdom that fortunately I got early in life. I wish I got it earlier. I got it in my 40s when I talked to Nelson. I think I was about 43, because it was that time when I was going through that work. Now there's things that people just agree on, but they don't practice. If you say, "Yep, cash is king," everybody says, "Oh yeah, cash is king," while I've got $600,000 tied up in my house that I don't have access.
That's not cash.
And then there's other people that say, "Wow, rates are really cheap. This is a great time to borrow money." Yeah, so why don't you borrow money? And then my favorite, when is the best time to borrow money? When you don't need it.
Mhm.
So everybody knows that you should borrow money when rates are cheap and when you don't need it, and that cash is king.
Yeah.
But yet, very few people follow those rules,
Right.
which is really weird. They tie up their money in long-term investments and then they cry when the stock market goes down.
Yep.
And like my friend Tom Hegna says, people that have this, that have all their money in the stock market are miserable. All they do is watch the market. I've been at people's houses and they've got CNBC on and they're
Oh,
glued to
right.
it, watching what's
Exactly.
happening with the Dow, you know, and
Mhm.
what's going on with their retirement. I know people that have checked their retirement account 3, 4, 5 times a day. Really? You know, aren't you concerned about enjoying life a little bit and going out on the
Mhm.
boat or whatever? So I talked to Nelson and I said, you know, Nelson, the thing that bothers me about this permanent life insurance thing is that no matter how you figure it, the rates of return don't come anywhere close to the stock market.
Mhm.
And I said, that makes me nervous. And he said, Harlan, it's not about your rate of return. It's the amount of money that you actually have available to you. He said, I can tell you that I made way more money on having ready cash available in my life insurance policy than I ever did in the actual return on the policy itself. Now, he said, the policy will give me a reasonable, consistent rate of return without losing money. And I'm very interested in not losing money. And
Right.
people, especially that are retired, should be concerned about not losing money.
Sure.
Because most people that I've talked to said, yeah, I don't think the stock market can keep going up while
Right.
they put some more in.
Mhm.
But the issue is that he said, Harlan, when you have money available to you and you have cash available, there's so much more you can accomplish than people that don't. Well, if you were to ask the average person, hey, can you come up with 100 grand like within 2 or 3 days? Like right now, if you got a really good deal and you could make 10 grand, if you could come up with 100 grand in the next 2 or 3 days, could you do it? I mean, maybe I'd have to sell this, or I could mortgage my house. Well, that'll
Right.
take 30 days by the time you get the
Right.
appraisal and everything.
Right.
And so most people cannot come up with even 50 grand.
Right.
Well, I was presented with a situation just like Nelson was talking about a few years ago. And it was being able to buy a foreclosed on office building that was worth at least 150 to 200,000, but it was in disrepair and it was in foreclosure. I went to
Mhm.
the bank had just got it back, and I went to the bank and they had some asbestos in that had to be mitigated, and it was a big problem for the bank, and they didn't want it. And I knew the building, and I knew what I could do with it, and so
Mhm.
I called up the bank and I said, I can get you $75,000 in by next Monday. This was on a Monday. I said by next Monday, because I knew
Mhm.
how I could get it out of my life insurance policy. I can
Right.
get you $75,000 if you'll accept my offer by next Monday. I don't need any financing or anything else. Here's the 75 grand. They
Yep.
agreed like within 2 hours.
No.
I then used some of my life insurance money to remodel the building. And after it was remodeled, I was able to take out a much larger mortgage to repay the life insurance policy. And
Yep.
I made just on that one transaction over $200,000 because I had ready cash available of 75 grand plus some more money for the remodeling.
Yep.
That
So
is
cash is
incredible
not
value.
trash. Like some people are
That's,
saying today, they're
that's
saying it's
right.
trash, right? But
Cash was
when
king.
you cash is king. It always
Yeah.
has been, always will be. If you have it, then the opportunities find you, right? I mean, you wouldn't
Yes.
even been considering talking to the bank and
No,
offering them 75 because you would have needed a mortgage probably to do it, a loan.
yes.
And yeah,
So the
so
issue is, you think about that, whether it's life insurance, whether it is a reverse mortgage, the availability of having ready cash available is critically important. I've seen it over and over. It also affects your peace of mind. And people forget that, how important it is. Because like I was telling the people that watch the stock market go up and down and they get all nervous when they're in retirement, when you know that you're getting a paycheck every single month from an annuity or from a life insurance contract or from your reverse mortgage line of credit, that it is coming in like clockwork, no matter what happens, that relieves a tremendous amount of stress because you don't worry about bills. And you can go have fun with your kids and your grandkids. You don't have to worry about what's going on with the stock market. You don't have to check your phone and say, oh, I wonder what's happening to the Dow. You can just read books to your grandkids. And
right.
so the weird thing is that people think that they need to get the bigger gains with bigger gains, of course, comes bigger losses, and a
Mm.
consistency of that money coming in and having that cash available. There's no substitute for it. And people are so confused. I had a client that called us one day after he had his reverse mortgage for a year or so, and he called up and he said, "Hey, I just got back from my doctor." And I'm thinking, what does that have to do with anything? And he said, they gave us a clean bill of health and said that we were healthier than the last 10 years that we came in for a checkup. And the doctor said, "What are you guys doing? I mean, are you eating better, exercising more because your cholesterol is down and blood pressure is good? And what's going on?" And they said, "Oh, we don't worry anymore. We've got a reverse mortgage." So I went to our, and that's a true story, John. And I went to our marketing people and I said, "Can we use this as a testimonial?"
Yeah.
And they said, "No, we cannot say that your health will improve if you get a reverse mortgage."
Oh, I love it.
That's not something that's okay, but it is true that your mental health and your worries have a lot to do with whether or not you can afford your bills. Just talk to somebody. One guy told me once, "Money isn't everything, Harlan, but it's reasonably close to oxygen."
Yes.
I mean, we kind of need it.
Yeah.
And when you
Yep.
don't have it, it's a lot of worry, a lot of panic, a lot of concern, and there's no need for it, because when you've worked hard and you properly have employed that money in bucket 2 and in bucket 3, you're going to be okay for the rest of your life. Enjoy it instead of worrying about it.
This has been a great conversation. Thank you so much for doing this. Yeah. How do people go about, looking into a reverse mortgage? It's not like there's, a reverse mortgage originator on every corner like there is forward. So is there
Yeah, well,
something we
I'm
can
going to do a
share
little
here?
I'm going to do a little bit of shameless promotion of our company that I work for. I don't personally do reverse mortgages myself anymore. I used to, but I help everybody else do theirs at Fairway. We have 600 offices scattered out through the country. We're the only
Okay.
company that has 600 in-person offices where you can go into, or we can have somebody come to you to talk about a reverse mortgage. You don't have to say, "I want one." You can just say, "This is interesting. I want to find more about this. And I don't want to be pressured into doing anything, but I just want to know, will this help me or not?" You kind of piqued my curiosity. I'd like to know what was going on. And so we have somebody that understands financial planning and often works with your financial advisor, just like you and I work together,
Mhm.
and simply go through the steps and say, "How does this work?" And to find out how that works, all somebody has to do is go to reverse sales at fairwaymc.com, reverse sales at fairwaymc.com. In fact, I think I even have it up here on my screen that can make it a little bit easier here. Whoops, that's not the right one. There we go. And that's my contact information. It's reverse sales at fairwaymc.com. They can email me too, Harlan A at fairwaymc.com, or call my office or my mobile number and say, "Hey, got some more questions about this." So that's really and the best thing is not to say, "Yeah, I'm going to do one." It's, "I'm skeptical. I want you to prove in my personal situation how this really works." And that's really the way that you need to find out, because it doesn't make any difference if it works great for the neighbor or works great for somebody down the street or somebody in Idaho and you're in Missouri. Well, something, let's just find out whether or not it works for you. And 95% of the time, it'll improve your retirement and be a lot more fun.
Yeah, a lot more fun. Well, again, I want to just give a little shout out for your book. You can find it on www.nashcashflow.com, which is my website. You can also buy it on Amazon, I believe, right? I think that's
Yes,
where
I'll make it a little bit better though. You can buy it on Amazon for 19 bucks or whatever it is, or for your listeners and for your clients, because I know they're serious about money and they're serious about education and learning, I'll give them a free copy. And so simply let me know, because my goal is not to sell books. My goal is to change the lives of retirees. And so anybody that's listening to us, contact us at Reverse Sales, say, "I know John Ward, the cash flow
All
guy,
right.
and I want a book," and we'll get you one.
Oh, that's so great. Thank you, Harlan. Hey, everybody, take advantage of that. It's a great read. It's just fun at the very least, and you really will learn something. And Harlan, thanks so much for doing this. This is really great. This is great
It's
talking.
it's wonderful. It's fun talking to you. You should be I know you are a great guy in the financial world, but you would make an absolutely great TV personality on interviewing people. You've got the looks, you've got the voice. I mean, if they find out about you, yep, that
Well,
you're
please get the word out, huh? Thank you so much for that.
thank
Very
you, Jeff.
kind. All right.